Hello, my friends. So I thought it would be fun to make a beginner video on option pricing. I'm going to be talking about the most simple option pricing model called the one-step binomial tree model. And although this model is very unrealistic, it does illustrate important concepts like no arbitrage and replicating payoffs in complete markets. So it's a simple model. It's not realistic, but it's a very good conceptual starting point. So let's first define these concepts, and then I'll show you a detailed example on how to price a European call option. We'll assume European for now. So arbitrage, what is arbitrage? Arbitrage is basically a free lunch or a riskless profit. To be a little bit more technical, it means your strategy will do at least as well as the risk-free rate, and with positive probability, it'll do better than risk-free rate. So meaning you have a no chance of losing compared to the risk-free rate, and a positive chance of beating it. Okay, so that's one concept, and we do not want arbitrage. We don't want free money, um, and even if you did have arbitrage, people would take advantage of it quickly, and supply and demand will make it that the prices will have no arbitrage anyway. And another concept is complete markets. So complete markets, basically you can reconstruct derivatives like options, for example, from simple products like stocks and bonds. So a portfolio of stocks and bonds can be basically synthetically like having an option. So that's a very important concept, because if you combine that concept of replicating a derivative like a call option with the idea that you do not want arbitrage, um, if you can replicate the call option, then its price should be the same as the portfolio that replicated it. So the portfolio of stocks and bonds. Of course, in real life, markets are not complete and all this other stuff, but it is a very good concept to know, because to an extent there is some completeness. So let's just get to business. Let's show the example. So just a few assumptions, a list: no transaction costs, no taxes, no commissions, that sort of thing, no bid-ask spread. That's an important assumption, and it's not realistic. And you can buy fractional shares, which is a little more realistic assumption. So let's first show you the model and show you how to price the option. So basically, let's assume S0 is the current stock price, $10. And we're assuming with probability 60%, we can double to 20, and with 40%, the stock goes down to 5, halves to 5. So the question is, how much would you pay for a call option with strike price equal to $10? So we know the payoffs at expiration. Let's assume that we only have time 1, that's expiration, when the option expires. Also, let's assume that the cost to borrow money is 0 to make the math easier. So risk-free rate is 0. So let me illustrate what happens. If the stock goes up, the option is worth $10, right? Because you would exercise at $10, and the current price is 20, so 20 minus 10 is $10. If the stock goes down, then you will not exercise the option, because why on earth would you pay $10 for an option where you can buy a stock where you can buy it in the open market for 5? So the option will be worth 0. So the question is, what should the option be worth at time 0, sorry. So naively you would think, okay, 60%, it's 60%, it's going to be worth $10, and 40% 0. So it's going to be worth on average $66. But that's not going to be good, because that'll give us arbitrage, and I'll explain why in a second. What we really want to do is we want to create a portfolio of stocks and bonds to replicate these payoffs. No matter if the stock goes up or down, our portfolio will have the same value as the call option. So then we can argue that at time 0, the portfolio needs to be the value of the call option at time 0. So let's go through this in detail. So first, let's talk about some trivial cases that most people don't talk about. First of all, if P equals 0, it means no matter what, the stock is crashing, then there's a 100% chance that it's going to be this scenario. So then the value of the option is $0, because there's no way, like, replicating doesn't matter. It will always go to this price, so it'll be worth $0. And similarly, if the probability is 100%, it's always going to be this scenario, so $10. So these are sort of the trivial cases. If the probability is 0, it's worth $0. Probability is 1, it's worth $10. What we actually really do care about is the non-trivial case, where there's any positive probability that just, it can't be 0 and it can't be 1. It's between them. So what we want to do is we want to construct a portfolio, and the goal is to replicate the value of the call option no matter the outcome. So let's consider a portfolio where we own delta, and it can be fractional, units of the stock, and we borrow beta dollars from the bank. So, and I'm going to illustrate this below in a second. So the stock, if the stock goes up, then the value of our portfolio is going to be stock up, SU, times delta minus beta. And stock going up is 20, so it's going to be 20 delta minus beta. If the stock goes down, our portfolio is worth SD, stock down, minus beta, so 5 delta minus beta, right? So let me show you guys in the picture. So 20 delta minus beta is the value of our portfolio if the stock goes up, and 5 delta minus beta is the value of our portfolio if the stock goes down, right? So because we want to replicate the payoffs, we want to choose delta and beta to, no matter what happens, if it goes up or down, it's going to equal 10 and 0, right? So basically we need 10, this thing, to be equal to 20 delta minus beta, and we need 0 to be equal to 5 delta minus beta. So these are the equations we need. We can try to remember algebra and get that beta is 10/3, meaning you borrow 10/3 from the bank and you buy 2/3 of the stock. So we can completely replicate the option by owning delta equals 2/3 shares and borrowing 10/3 from the bank. So if this replicates the payoff, to have no arbitrage, the value of the option times 0 needs to be the portfolio that replicated these payoffs. So that portfolio is 10 delta minus beta, right? Because stock price at time 0 is 10. So it's 10 times 2/3, because remember delta is 2/3, minus beta is 10/3. So 10/3 should be the value of the option. So that is a trippy thing to consider. So a couple of key points that's interesting is it doesn't matter if probability is 99% or 50%, the value of the option is going to be the same, because you don't want arbitrage. If it's 99%, then you just have to wait like 100 times to get your so-called arbitrage opportunity. And so that's interesting though, like a very trippy concept that doesn't matter if 99% of the time the stock goes up or 50% it goes up, the price of the option should be the same to avoid arbitrage. Very weird concept for beginners to understand. Of course, in real life, if it's probability 99% that the stock will go up, please buy the option. You're going to be a millionaire. But doesn't mean that the option price should be different. And in the real world, of course, markets are not complete. It's not so easy to create a portfolio that will replicate the option price. So that's a big assumption we made. And of course, there's transaction costs. So I do want to illustrate one thing. If the value of the call option is less than 10/3, then the option is basically underpriced. So you should buy the call option and short the portfolio. So then, no matter what, you're going to have a positive profit whenever the stock goes up. And the opposite way is if the value of the call option is above the value of the portfolio, then you should, the call option is overpriced, so you should short the call option and buy the portfolio. I don't want to get into too much math with this because I didn't write it in my notes, but basically there's only one value that gives you no arbitrage in this case, that's 10/3. Any other value you can get a riskless profit. And thank you guys. I hope you guys enjoyed this concept. Thank you guys.